This is the Net Group Investments Insights Podcast, where one or more of our experts explore a variety of views and insights that investors care about.
Hello, I'm Trevor Garvin from Net Group Investments Multi-Manager. Today's voice note is entitled, "The Spike in Brent Crude Oil Price Causes Global Inflation Jitters." The geopolitical landscape shifted abruptly this week. After weeks of an extensive military buildup in the Middle East, Israel and the US launched a bombing campaign that killed Iran's supreme leader, the Ayatollah Ali Khamenei, and top military brass on the 28th of February. The attacks triggered extensive Iranian retaliation across Israel, US bases in the Gulf, and key civilian and energy infrastructure. Airports and seaports in the UAE, Bahrain, Qatar, Kuwait, Oman, and other Gulf countries hosting US troops were targeted. And although most of the Iranian missiles and drones were intercepted, flights in the region have been severely disrupted. The airspace has remained shut, causing significant disruption to air travel in a region that has positioned itself as a global aviation hub. Iran announced that the Strait of Hormuz, where nearly 20% of global oil and gas transits, was closed and threatened to attack any oil tanker that attempted to pass through. The longer the conflict continues, the higher the risk of a disruption to global oil and gas supply. Yesterday, the previous Ayatollah's son, Mojtaba, was voted in as the next supreme leader of Iran. Emerging market assets bore the brunt of the volatility. Currencies and equity markets plunged to multi-week lows, while bond yields rose as the surge in oil and gas prices stoked inflation fears that could alter the path of global interest rates. The rand, which had been trading on a firmer footing around 15 Rand 90 to the dollar ahead of the conflict, weakened sharply to 16 Rand 85 during last week, its lowest level since December, and down 4.5% for the week. This morning, it is trading around 16 Rand 33, having made up some of the lost ground. The US dollar broadly benefited from its safe haven status and has risen to its highest level since the second week of January against the euro and the British pound. In the domestic equity market, the JSE All-Share Index was lifted by basic materials, which gained despite lower precious metal prices. Industrials and financials were hurt by renewed growth and inflation worries triggered by the Middle East war. In the US, the Dow is down around 3% as at yesterday's close, while the Nasdaq plunged to its lowest level since mid-November as war-driven uncertainty amplified investor scrutiny of tech valuations already pressured by concerns around all the AI infrastructure spending that is underway. European equities fell deeper than US markets, hurt by Europe's high reliance on imported oil and gas. The sharp rise in prices of energy goods threatens the Eurozone's fragile economic recovery and the slowdown in inflation, with grave implications for corporate earnings. The FTSE, DAX, and CAC 40 were all down around 7% for the past week, whilst emerging markets, including South Africa, are 8% below their highs just over a week ago. In commodity markets, oil prices jumped to their highest level seen since June 2024, dragging other energy prices along. The Brent Crude oil price surged last week when the conflict broke out, from $72 per barrel to $82 per barrel, as the closure of the Strait of Hormuz throttled a key artery of global energy supply. Jet fuel prices jumped to the highest level in over 5 years, surging by 71% this week on supply concerns. The gold price fell as investors fled to the safety of the US dollar, while platinum reversed gains of the past 2 weeks. Yesterday, Brent Crude traded as high as $119 a barrel, a rise of more than 70% in a week, before reversing sharply. The pullback followed G7 discussions around releasing strategic reserves and comments suggesting potential de-escalation around the Strait of Hormuz. Brent Crude is currently trading at $89 per barrel. Gold is trading at $5,090 per ounce. In bond markets, the South African benchmark 10-year yield broke through 8% after it touched 7.81% following the generally positive budget statement last week by the finance minister. It has risen to 8.36% this morning. The US 10-year Treasury yield has edged higher to 4.14% after dipping to 3.96 last week Friday, with this week's rise snapping a downward trend that started in early February this year. We will continue to monitor developments closely. Investors should remain calm and stick to their long-term investment goals. With thanks, till next time, Trevor.
This podcast is for marketing purposes only. The information contained in the podcast or video was for information purposes and does not constitute advice, recommendation, or an offer or solicitation to purchase or sell any funds or strategies to any person in any jurisdiction in which the offer, recommendation, or solicitation to purchase would be unlawful.